Hello everyone, welcome to another episode of Finance Forward, where we discuss finance, accounts, and everything that counts. Today we have Sasha Mirchandani, who's the founder of KAE CAPITAL. He's been a source of help ever since we at Zell were thinking of fundraising. I remember 3 years ago we had a quick call where someone had featured us and we were naive students, the naive entrepreneurs saying that you should raise every edtech is raising. And someone told us 25 million crore. At that point of time, US was printing money and all the takes around was just lit scaling in terms of funding. And I remember he said, yeah, kya 25 million? Why do you, she said, what is 25 million? You said 25 crore, bahut badi baat hogi. So, I mean, you know, this whole culture which has happened nowadays of the raising because it's required by every startup is something which needs to be addressed. What do you think on top of your mind, if you remember the call 3 years ago, and any advice for startup founders who are just starting off that nahi karoge to bhi chale?
Yeah, of course, nahi karenge to chalega because it's horses for courses in life.
Yeah.
So you got to realize the journey that you want to partake of, and that journey has to partake of what you need to build and what you want to do in the next many years.
Sure.
So each company, each individual obviously is different. And it really depends on what you need to do and why you need that VC money. Right? Because once you get it, you remember you have another owner on your cap table.
Right.
He or she may not be running a business, which obviously they don't, but they then play a part in making some decisions that you may or may not like.
Yeah.
For a vast majority of reasons, the VC money does work.
Yeah.
For many reasons, it doesn't work as well. And especially if the fit is not right between what you want to build and what the VCs or private equity funds want to build. And therefore, it's very, very important to rethink. Do remember that 90+% of the world is living without our money.
Correct.
So it's not that important.
Yeah.
It's more about those 5-10%, and even probably even lower than that, as we're being built out maybe 3% of the world's companies. There are people like me. And therefore, you have to decide, are you in that 3% or not?
Yeah.
Being in 3% or not doesn't make you successful or not successful. There are tons of people in that area who obviously were extremely successful. And therefore, beware before you jump into our...
Yeah. But do you think every kid who's starting off at saying, listen, I'm going to become an entrepreneur, I'm going to do a startup, is thinking of the first thing is raising nowadays?
Raising it become glamorous.
Yes.
And I think that itself is unfortunate.
Yeah.
It's just one more milestone in your long journey.
Yeah.
It's not a destination, it's a journey. Life is a destination. And therefore, raising capital, of course, is a credit to them or her. They raise capital, they get money out of us. Even a small fund like us, we don't write more than 70 checks a year.
Yeah.
So we're giving money to an entrepreneur. It's a big deal for us.
Yeah.
But that doesn't mean that company is going to become the best company in the world.
Correct.
And therefore, the entrepreneur raises, say, $2 million from us or $20 million from a larger VC fund. Good news. Because now I'm going to be joining his board or whoever the fund is. And then I need X return over the next period of time. Then again, there's another round of capital. So it's just one more.
As a rule of thumb, I know, this is not definitive, the answer you want to give, but if you have to say that a return on the money invested, because you also have people investing with you and you're also investing in that fund, which goes on to the founder or whoever is raising, whichever startup you pick to invest in. As a rule of thumb, what do you think is a reasonable return for a VC to have at an early stage?
So every investment we make, gentlemen, has to be a massive home run.
Yeah.
The VC industry is, both of you know, I'm sure all the audience knows, the power law. So you say you make 20 investments in a particular fund. Maybe one or two will become the very large outcome within $1 billion plus.
Yeah.
But every time we make an investment, we have to foresee that our research tells us that this company is $1 billion plus company.
Yeah.
And therefore, every time I look at you, I'm like, hey, can he or she build a company? Funds are getting bigger and bigger.
Yeah.
So therefore, they need to, each investment they make have to return X amount of that fund to make it viable. So let's say our fund, and 100 million fund. If we don't return at least 50 million of that from your company, it's a failure for us. So ideally, it should be multiple times the fund, which means your company has to get me $300-400 million.
So minimum 3 to 4x is what you would say over a period of time.
Not really, substantially 100x. That's what we're looking at.
Yeah.
We obviously don't get 100x very often.
Yeah.
And that's the power law generally play out. Like we've all studied it, we know about it. But is it, if you average out everything in your history, is it true that 1 out of 10 on an average work out, and they are multi-baggers that they make 100x and make up for the 9 which are not taking the return XYZ. I've also heard use the rule that one goes up, 2 or 3 are break even, and the rest are in losses. Is it really like that?
No, it's not like that. And that's why many VC funds shut down. Yeah. Right? That's life. And therefore, new VC funds go. And the ones that are doing it over a long period of time, of course, so you will check which funds have been going on for 20, 30 years. Yeah. They clearly would have 100% had the power law work for them in month. For example, Aspire or Lightsource. Right. These firms obviously the power law working to them. But there's so many firms that if I give you names, you won't. There's no way I remember that fund. Yeah. It's gone. Yeah. And the business works like this. Think of a movie business. So nobody makes one movie and hopes for the best. Not rich people that had a check, make a Shah Rukh Khan movie. But the movie's down the toilet. You try the money. But we have to have a slate of movies. Like Dharma Production is so successful there. That's right. Similarly, we have a VC fund very similar. All VC funds. You do 10 investments. All have to fail, especially at the stage we come in. Sure. Yeah. Private equity can't, there's different rules though. 3, 4 will be average returners, 5, 10x, whatever. Yeah. And then 1 or 2 are the power law. Right. Every fund has to at least one power law, at least in very early stage. Otherwise, you're screwed. Yeah. Yeah.
And is it true that the history of venture capital essentially started more or less in Silicon Valley? It was Apple, Microsoft were the sort of first few companies which really took the bet on raising a lot that at some time in the future they'll become profitable. I know Amazon came a little later, but was it all Bill Gates and Steve Jobs who really sort of sparked this whole VC bit, or even venture capitalists that we've met think on the lines that, okay, it's okay, let's go for hyper growth, let's maximize growth, don't worry about losses for the beginning, let's get as many users. And then as long as your unit economics have the potential to become profitable, at some point once we capture the market share, we'll turn the dial up on profitability. And at least whatever we've heard, including in EdTech, that's the play. Is that really how it's all panned out over the last 30, 50 years?
VC's been around for about 30 plus years in the US. It was even before Apple. Companies Genentech and stuff like that. Those funds used to be $3, $4, $5, $10 million funds, that's all I remember. Like what we consider micro seed funds today was what the industry started with. And there's a whole bunch of historical data available on the internet. Anyone go read it. Don't bother with that history. But that started from those days with smallish funds, and now today they've become the huge funds that we talk about. Venture is also a matter of access to capital. So in what markets, when a situation where easy money is available, people are throwing money behind it, a bad habit start, and rest in history. Yeah. And we have gone through one cycle last year. Yeah. And we can see the repercussions of that cycle as we speak every day in the papers.
Yeah. So in 2022, what happened was, I just backtrack and tell everyone. In 2020, when COVID hit, US started printing money. Now, isn't that repercussion also very, very large?
Very large. It's still playing out.
It's still playing out because our money back in India, the value of it decreases overnight because inflation kicks up. There's so much money in the market that's in many different ways. And then companies in 2020, with their fundamentals must have been lower. They started raising enormous amounts of money. But wouldn't also the beneficiary only be companies like Google and Facebook?
Well, Google and Facebook are phenomenal business models. Yeah, they benefit from a wide variety of things. Yeah, beyond just what you just said. Yeah. So I think they're thriving, and if you see the US market, stock market, it's these 7, 8 companies, and Magnificent 7 that have really gone up again. Versus everything else has been below a certain threshold. Of course, there was, like I said earlier, cheap money available in 2020 and then parts of 2021, where there's no question on business models. So, you would get a term sheet on a Wednesday for Series C and on a Thursday with Series D. There were not that many examples of this, but I can guarantee you I knew of many. Right? That itself doesn't make any sense, right? How can you have a higher valuation a week before, a day later? And on the first place, the Series C itself is already way too expensive. Yeah. And then you're talking about Series D. But that repercussion being felt today because these companies have gone so ahead of their skis in their valuations. It's going to take a while to catch up. Versus in the US markets, you're seeing a lot of down rounds happen. Yeah. And you see an Instacart IPO, it was at 9 billion, right? 40 billion, 39 billion last price. You see Klaviyo, you see for a bunch of companies. You see they were looking at a much higher valuation, but they ended up in 40 or 50 billion if I remember correctly, and then many more. Yeah.
Is it, I know a lot of founders who, when they look at fundraising and they get it, they're thinking of it as an achievement rather than the start of the real obligation. It's I would say it's a liability, but now you've got to be obligated towards towards the capital that you receive. Fundraising as the is the reason they created the MVP or the reason they started the initial journey. So when you've met, I'm assuming when you say you've got 70 checks a year, it means you must be meeting way more.
No, 7, 8 checks.
7 to 8.
Oh, I'm so sorry. I missed
And
it.
another $100 million fund. You're only cutting 7, 8 checks.
Yeah.
So okay, so then my question becomes even more, it's even more sharp. So then, how do you really figure out especially first-time entrepreneurs, how do you really make that assessment? Talking right only about the person model and the business and the market size, we understand. But I've met really smart people who make this mistake alone. They assume fundraise is the bigger.
Fundraise is obviously be happy you got money out of good VC and that you aspire to get money out of. Nothing to be sad about. It's a good, happy occasion.
Yeah.
But it's not a celebration. It's just a milestone. It's a long way to go because now that VC will sit on your board, him or her will expect certain returns out of you. And therefore, now you also have a partner with a large shareholder in your company. You need to get some reporting done. So there's lots of, let's say, baggage that comes with the glamour. So be aware, you can't have a situation where you get what you want and the VC this around.
Yeah.
They're going to demand what they need to get. And you have to be aware of that.
Yeah.
It's not a big deal. It's not some earth-shaking requirements. But if you're not aware and then you take the money, then that's not a happy situation for you.
And then just a step further in that question, we used to discuss this a lot, that how does it work? Let's say that the founders are not able to provide the return that is expected, which of course happens. I've seen some of at least the people I know one-to-one, they overestimate what's on Excel 3 years down the line by wrongly predicting the market as much larger than it is, or the acquisition of those customers is much easier than it is, and they don't end up being able to generate that kind of return. So how does it work in that scenario?
Venture business is like a movie business. We make, say, 10 investments in the fund. We do more, of course. 4 will fail for sure, unfortunately. When I say fail, I mean shut down or sold for pennies to the dollar. 4 will do adequate returns, 4, 5x, whatever. And then 1 or 2 are the ones that break out and call that the power law and become the huge businesses that we aspire to get. Every VC fund, every time you do a VC fund, it's very, very important to get a power law hit and get a very large output. Unless you decide to raise a much smaller fund, then mathematically don't need to have it to go exit. That's something that we keep in mind. Yeah. And we end up with smallish funds, like including our last fund, which is 100 million. We could have definitely done more. But we took into cognizance that it's not every day you wake up and you get a unicorn.
Yeah.
And if you do a smaller exit, we should be good to go with extremely healthy returns.
Yeah. So, Sasha, you sit on the board of a lot of companies from whatever. You've been in this business, I think, over 20 years now. What are your biggest hits at KAE so far?
Well, before getting KAE started with, we have done many investments. See, like I said, it's all about the power law. So nobody talks about the company that's shut down.
Sure. Yeah, I'll come to that because I have questions later. Yeah.
So my very first investment was a young team based on the East. And I'm proud to report that in 2021, we became a unicorn 20 years after I funded them.
What is a unicorn?
Factor analytics.
Okay. Is it US based?
No, it's based in Gurgaon.
Okay.
And of course, it was big US presence.
Yeah.
One founder is in US Pune and she can't in Mumbai.
Yeah.
Also incredibly well. TP is give us 400 million. We've been lucky enough to partner with Mukesh Bansal, invest in Mitsuram, in Mobi, etc. In KAE, we've been lucky to do many more investments. Companies like Healthcart, 1MG, Porter, this one values further out. A company called Zetwork, etc. We invest Square Yards.
Yeah.
Nazara, new IPO.
Nazara, you did fantastic. Yeah. And what are the conversations like when you're sitting on these boards? We're not talking on a day-to-day basis. That when you're going for a board meeting, audience wouldn't know probably what a board meeting is, or even if they know what a board meeting is, they don't know what kind of conversations they're driven over there. Is it usually about revenue, product, marketing? What is it usually? What is the major report? Is it about revenue? Is it about expense? Or is it about something else?
I think it's a little of everything in every board meeting. And there are very few board meetings where you say, wow, everything is awesome. In fact, I remember one board meeting where we said everything was awesome. We see one company and we all clapped and we were so happy. Because the last board meeting was full of stress. And this but be surprised if we clap again the next board meeting. And this company is performing really well.
Yeah.
And they're a company, they're a unicorn. But there's always issues across the board. So the best board meetings are where you don't have to just read the screen and read the slides, because we should be prepared well in advance. It's where the management team, obviously with the CEO leading this initiative, is driving the agenda for what he or she needs in the board meeting. Like, okay, this is the fiduciary part, this is where I need to show you the slides, but this is what I need from the board in this meeting. So I'm going to carve out X amount of time to discuss that. So you've done well. A well-run board meeting can be extremely effective, even if the company is not doing well. Versus a bad board meeting can just waste everyone's time and just be a good tick mark and you walk out of the room.
And which of these, I'm assuming that every company as a VC would invest in, you're hoping, or you still, from the ones which you just named, any of them you sort of had higher conviction than the rest that these ones would really get out of the park?
You know, when you fund, the optimism is at the highest level. So every single deal we think will be out of the park. If we don't have that feeling, we don't do a single investment.
Right. Okay.
Reality hits very soon, and in a year you can tell whether this company will go anywhere or not.
Yeah.
Though many of the investments have been, which have become very large businesses, eventually pivoted. But that showed lots of flexibility in the founders to move quickly to figure out what works. And then he or she figured out product market fit. And the business is conceptualized on day one when it sat in front of us.
Yeah.
Or eventually became the big company that today everyone knows. It's a very different business.
So actually, I wanted to understand this one point. That see, you're an early seed fund, right? Which
Extremely early.
extremely early. So it's more as the first check.
Very first check, sometimes concept. Like, say you guys are leaving your jobs.
Oh wow.
But you know, we've done even on a business plan.
Okay. So on an average, the time of conceptualization, whatever the model was, whatever the prospect of the business was, let's say 1 or 3 years down the line, on an average, how many companies actually stick to it? Because I understand the pivot point in various ways, but even from conceptualization, literally in the next week, there are things which you change from what you were thinking just to make sure you adapt to what the customers or the market is reacting.
Correct.
So how often does it stick to the original plan?
We have had some companies that have stuck to the original plan, but bulk of them have had made some iterations, and some have done dramatic iterations. So
Okay.
we just give an example of the investment we recently made about 4 months back.
Okay.
From the time we gave the term sheet and the SHA was going on paperwork, the entrepreneur already secured it. That was the fastest in my life.
Wow.
And we were fine with it because the founders obviously had checked out very strongly. And we didn't panic because we bet on a certain, let's say, thesis on why he or she could build that business out. But we believed that they could build out on this, let's say, and pivot as well. We were okay with it, and let's hope for the best.
So, Sasha, assuming I come to you and you and I don't know each other at all, and I tell you I have this X idea, whatever the idea may be, you like the idea, maybe forget the age, forget anything. What is your basis of saying, okay, let's do this deal? How is the process done in KAE Capital or your philosophy over here? From, if you can give me a detailed answer on.
You know, first of all, I recommend to founders is best to get in front of any VCs. It comes through a strong reference. So they have lots of mails on our website and direct, and of course we answer them respectfully. But it's like, how do we know that these guys are awesome? Just from on deck, it becomes very difficult. But they're recommended by someone I trust and respect. Then this team goes to the top of my inbox. When I say I mind anyone in KAE Capital, any VC in the world, where they take that much more seriously.
Yeah.
And then you come to the filter. In KAE, we have something called D1, D2, and D3.
Okay.
D1 is a bulk of the thousands of deals we see every year, where we put IT decline.
Yeah.
Of course, many of them have become great companies, and too bad for us and good for the founders. D2 is where someone reasonably senior is spending time with the company over a few weeks. We have a rule, 4-week rule, that beyond 4, only for really exceptional reasons, no company should be on our deal book, either yes or no by then.
Okay.
So the next few weeks, some of this spent on D2, by which time they mostly then passed as well. This is where at least one partner would have spent some time.
Okay.
And then something called D3 is deep due diligence, where the partner would have spent enough time, got the team in front of the whole team, done lots of diligence, created a document called the business case analysis, which is our final document before we make an investment. And then we send an investment memo, and then we take a call whether we want to invest or not.
Yeah.
So let's see, about 20 companies may come up to deep due diligence, or 25 or 30, I don't know the exact numbers. And like I said, we end up with 5 or 8.
So this is out of 1,000.
No, but 3,000-4,000.
Oh, out of 3,000-4,000, you're just letting 7 or 8.
That's the thousand for most VC funds.
Yeah. And FOMO doesn't get to you at all.
FOMO is, we are human after all.
Yeah.
So, of course, FOMO gets to us, but you have to speak calm. And it's very important not to get into FOMO, especially in waves. Like, people ask me, what's the next speaking? I feel very reluctant to answer that question. Because if you're already talking about the wave, it's already a hot topic.
Correct.
And everything is marked up and all very expensive.
Correct.
So our job as very early stage VCs is before the wave comes, we should have made a decision on a particular category and taken a bet or not taken a bet.
Sure.
But once the wave comes, which is one among many people in the sea of VCs and entrepreneurs that throwing their business plans and we're trying to grab that.
Jeff Bezos said that I don't want the new age companies to come. I'm running a traditional business. I'm an online shopkeeper, is what he's saying. Now, because you spoke about Wave, Pratham and I both, when we saw 2020, 2021, all edtechs around us just raising gallons of money, we were also caught in this FOMO. And, before it started, you just said that we don't need to raise money. So what is your thought on that a little bit? Yeah.
You mean you're starting a company and raise capital?
Yeah, I mean, there are majority of the companies back in the day, like you said, they could start with very, very little capital. They don't need a venture capital book, proof of concept comes in. If they really want to grow it up and they have that kind of a team, which team also matters a lot. And
today the access to the angels.
Yeah.
When I started angel investing in 2001, people didn't know what the concept of angel investing.
Correct.
It was like a joke. And what is angel investing? But now there are very sophisticated angels in this country, in India. Either individuals, I'm co-founder of Dubai, there are 1,000 members, there's so many more clubs. There's these awesome entrepreneurs who are angels, who can add a lot of value to your capital.
Like the sharks.
Sharks, but like them, but in the individual they are actually. And they can easily put a $500,000 round together for you very easily. We'd use that and then come back to VC like me. Of course, we can do the $500,000 as well.
Yeah.
But the reality is we were a little bit more structured process.
Correct.
Versus the radiation, right?
Yeah.
But don't remember, it's their money. They don't give you money in 10 seconds.
Yeah.
You need to do some diligence. At least the sensible ones. And that's available today.
Yeah.
So can you tell us the difference between an angel investment and what you are doing as almost a very early seed fund, where you also anyways invest the first check? So what's the difference?
Yeah, there's really not much difference. The only difference is our money. We are taking money from other funds, endowments, Asian eyes, who have family offices, and then deploying on their behalf.
Yeah. And I want to go back to what you mentioned about the wave. So it's actually a very interesting point you mentioned that you have to try and figure out the wave before it becomes the wave. So if you could just share, beyond studying and keeping eyes open perpetually, how do you sort of stay at the top? How do you make the right bets? How do you gauge whether it's a bet to be taken?
Obviously, it's super hard. There's will be every entrepreneur that pop by will be writing a check in. It'll be a $5 billion company. And then to predict the future, as you can imagine, it's more about just being aware of what's going on in the world, asking the right questions, talking to experts, and constantly thinking through what he or she thinks the future will bring to the table. Obviously, many of these bets will be very wrong.
Yeah.
But if you go right, can you imagine?
So can you give us an example of something that comes to your mind when you did work towards a trend that you thought you took a bet and you invested in a company and it paid off?
There are many examples. Let's say one of my colleagues, she had done some work on mental health, and she was scouring it. And mental health has always been unfortunately under the radar.
Correct. Yeah.
Because no one really wanted to talk about it. And, most people suffer from mental health issues, unfortunately.
Yeah.
But it's a taboo topic or not even understood. But to her credit, she understood that this is something that would pop up, and it's a much bigger problem than anticipated.
Yeah.
I myself took it to lightly, saying, hey, come on. Mental health is an issue, but who's going to talk about this in a scheme or a big enough opportunity? So she had found a very interesting company she wanted to invest in. Our IC had rejected it, but to her credit, she kept pushing back, explaining very logically why mental health is going to become very big. Of course, the founders were outstanding, and finally we came back to IC and we approved that investment, the company called Zell.
Since we're speaking a lot about which companies have gone from X to 100X and things like that, as a VC, you also seen two things. One is, the hardest hit is, you like something, but you just don't like it enough for you to invest in. And that becomes big. The second is companies which you've invested in, and some of them must have been super promising, and they've gone down. Now, since you have the burden of money to be invested in getting X return to again to your GPs, to your LPs, how do you deal with that pressure?
You mean when companies don't pan out the way they should?
The two things. One is companies which actually you said you passed on. It was a hard pass for you, and the second one is companies which did not,
Yeah,
give the
let's
return.
answer the first one first. We won't be good if we don't see many companies that we passed on.
Right.
Consider the fact that when we come in, there's no data. Actually, it's very, very difficult business. It looks very glamorous, but early stage venture is easily one of the most difficult businesses because your decisions are more art than science.
Yeah.
You just two entrepreneurs sitting in front of you, maybe 6 months of traction. Then you got to pick 5 of those out of 3,000 that come to you in a year. As you can imagine, logically, it's an extremely hard business. So the chances of missing, let's say we missed Ola, Oyo, and keep going.
You have missed those.
Yeah, worse.
Oh,
And therefore, it'll be impossible not to miss. That means you're not seeing the best companies if you're not missing those companies.
okay.
Every VC firm either these two companies that they've missed on, and over a drink you can have a reminiscence.
Yeah.
We reach term sheet scale sometimes, heavens and it is not big enough. So that's life.
Yeah.
Obviously, keep learning and saying, okay, next time someone like that comes, can I be more agile?
Yeah.
And go for it. But, two companies can never be compared. And to your second question, where, say, a promising company doesn't pan out, obviously they're very disappointing. But that's our job to communicate to the LPs, look, this is the reason why it didn't pan out, this is what we learned from it. And because, like I said earlier, our business is about 10 companies. As long as you have that 1 or 2 power law businesses that pop out, we're good to go.
Yeah.
But, you don't know which the power law is till many years since those companies started,
Yeah.
till they break out, unless very few they break out in year 1 itself.
So how do you handle pressure? You're on board of many companies.
Yeah,
Things can go wrong in any place. How do you handle?
if you're depressed, you think of the past.
Yeah.
If you're actually thinking of tomorrow, if you're at peace, you're
Today.
yeah, that's how it is.
It's very easier said than done in this, especially to kids who are giving exams and they're constantly thinking about what's going to be the next exam, what's going to be the next test. What is your one recommendation for them that, stay in the present is great, but anything which they should be doing today, which will probably help them?
I've not done it enough, but when I've done it, very rarely, super helpful is meditation.
Okay.
And I should think it was focus, but I do it now. But again, I'm repeating very little of it. I should be doing much, much more of it. I'm by nature a very impatient person. And the days when I do that, just 3 minutes, it's helpful, very helpful. So if you can find a way to inculcate a habit of meditation, in this calm you down. Another way to do it is the end of the day, just think about for 5 minutes things you've been grateful about for that day. Grateful doesn't mean, I went to the world's best restaurant and had lunch, something. Grateful about small things, I got a chance to walk next to this beautiful garden, good view. Anything that is sensible, or I did something interesting today and I was grateful for that time, for that interview with these 2 youngsters. Whatever you feel. And another thing I do when I wake up in the morning, whenever I do, which is to be early, I dust my feet to the ground to wake up. I, in already a positive mood, frame of mind, by telling myself how lucky I am to be alive in this great moment. I don't go to temples or mosques or churches. I'm not religious at all. None of this is hocus pocus. It's just gratitude. It's gratitude.
Yeah.
We don't have to be that grateful about a Ferrari. We're just grateful to be alive and having some good friends and a drink with a close friend is some fabulous. And post-COVID, that's much heightened.
Yeah.
You need to understand that even the smallest things are taken for granted.
Yeah.
Or when I broke my leg in a squash accident, I couldn't walk for a long time.
Okay.
So now when I walk, I am feeling gratitude.
Okay.
When I was an operator and ran businesses, I used to work 16 hours a day in places like Malad. So if I'm doing 10, 12 hours, it's a holiday.
Yeah.
When I come around, I'm like, oh man, this is a holiday again for me. It's a joke. That's how I work because I've already done that.
And when it comes to, do you have any inputs, opinions, thoughts on the pedigree of founders when it comes to education? Do you think that if they've done through formal education, it just could be a postgraduate in MBA, chartered accounting, whatever it is at its peak, is there any benefit, according to you, in your history, if you look at the data, that there is a higher success ratio or lower or equal to founders with pedigrees?
There's some correlation between obviously well-educated big founders to people who have not been educated. But frankly, it really doesn't matter. Where it helps is the optics in early stage, because when we're looking at a transaction, which is three youngsters, there are many factors we look at. Obviously, one of the easy filters is a well-educated person in IIT or whatnot, Yale. So it's a good tick mark for us. ये तो smart आदमी होएगा or smart woman होएगा. But if the company then moves to CDC or D, nobody really cares even which college they went. So what have you done so far? So life is not very if you go to a top school. India is really harder for you to get such initially
To start off.
to start off. But once you prove that you are no different, if not much better than the so-called fancy Ivy Leaguers, then nobody will ask you about education. Who cares?
So the right way to frame it for us is it right to say that when you are young or starting off, to get your foot into the first door, the academics matter, and then after that it's completely based on your performance essentially. Is it?
Yeah, it's fair. But if you are someone who believes in what you're doing and you're a high quality founder, then you will find a way to get money, even if you haven't got to the Stanford. And then it does matter. Maybe it takes a little bit harder. That's like,
But it's marginal according to it's not something significant.
if someone is going to be curious and say, I only want IITs and IIMs, then don't go to that person. I think it just helps our cause.
Sure.
But of course, we've done many companies that are non, Ivy League.
Any example of a founder formal, barely any education in the formal sense of it, but has killed it, has done really well for you?
Two, but maybe I don't mention his other name.
Okay.
Because he may not want his name to be out there. Maybe he said a cute name. So better that I don't.
Can I flip it? Is it possible for you to share? So you said you passed on Ola and Oyo. Can you tell us what really went through your mind when you actually had rejected them, like the stage they were at?
Ola actually, me and my young colleague Shashank went Bhavesh in the post-season lobby. Like I said, we see 3,000 companies, of which obviously you don't see all of them in live pitches, but we see hundreds of pitches in the course of the year, right? And that pitch was in 2011. But I still remember, I don't remember the questions we asked, but Bhavesh's presence and the way, clarity of thought was just amazing. I still remember that being, not that he became a Bhavesh Agarwal and Ola, even till today, he was that good. So we immediately exchanged notes after the meeting. Said, "Oh, this guy is really good. We should definitely take next steps." But unfortunately, we were a little late in his cycle. Around was raising capital, and this is Sasha. Now I've just got a top sheet this weekend, so we just missed it. Okay. Of course, there are many examples where we foolishly, it's a good example of really liking it. I'm not saying that we're not reading a top sheet on one day, but we have definitely taken another, continue to take a deeper look.
And Ritesh,
I met him later in life, of course. But there were many calls to meet him at 19.
yeah, he was very
Saying, hey, to meet him is awesome and this and that. But I passed to one of my partners. And to be fair to my partner, 19 years old, this is Sasha, good guy, but 19. So I said, I agree. It's fine. We'll do something else. So obviously, it's our combined fault. So I missed.
Understood. One, I want to ask a slightly, question on the VC business overall. Can you tell everybody in more simple words, how does the business model of venture capital really work?
Well, business model works like this. People like us go and raise capital, like I said, from investors. There's several types of investors. For much bigger firms, you go to endowments and so on and so forth. Smaller funds like us go to family offices, individuals. And now in India also, lots of good institutions that invest in funds like us. Generally, we see the very long gestation periods. We do funds for about 12 years. Something called 10 plus 2 to 10 years. And then if you believe that some assets still have value, we extend by a year. This is a long period. So we're very patient investors. We're not expecting exits in 2-3 years. It's foolish. Every investor we make, we hope it will become an IPO.
Yeah.
Only a small percentage will become IPO. Most investors globally, and it will definitely lead to M&A exits. So what happens is, we see firms sometimes start with at least 2-3 people. They're the founders of this firm. These people then hire smarter people than themselves. They come on board, and these become the investing team. Of course, where they go out and scour for deals, like I mentioned. Once you decide that you want to invest, I've explained the process. We have joined the boards of these companies and made a mail on the board till we make the exit. Every fund is different. In our firm, in the early days, we spend far more time with the entrepreneur because that's when you go into their journey of PMF and they need to, validate what they're doing with VCs like us. As they scale, we move towards 3-month board meetings, where we have much more structured, longer meetings. But then by the time the founders become seasoned, you build an executive team, and so on and so forth. And then hopefully, like I said, it's a path to IPO. Most eventually just get sold at some point. Right?
And what is LP and GP?
LP is limited partner, which is we invested into us, and we are general partners with the VCs.
The ones who are also, you have invested and you're the one who is running the VC firm. That's also general.
No, we're investing their LP's money. Okay, I'm a general partner.
So the general partner does not have, generally, they don't invest
No, we
themselves.
do. They expect subsidy.
Something exactly.
You're not that rich, like our friends. So we invest X amount, as per a mutually decided amount. For us, it's a reasonable amount. Today, you want to put balls, keep in the game, obviously.
Yeah.
But the LPs are the ones who are driving the industry.
And when just, this is something I've always been curious. So, people like you who have started VC firms, I'm just thinking, when you must have gone to the first few limited partners, right? And you would have spoken about, how does that conversation go where, based on what does a limited partner agree to invest in an upcoming VC firm?
It's the hardest thing in the world to do a first fund. Not because I did it, but it's just very hard.
Right.
And unlike an entrepreneur who wasn't, gets spiker rejections, maybe we over the years get hundreds of rejections, thousands. So you got to just remove your ego because let's don't do this. And anyway, ego is not great for anyone.
Yeah.
And face reality, understand why that person said no. Improve yourself, and maybe the company is not fit for them anyway. Maybe you're fine for it. As long as you believe that there's merit, we entrepreneurs to start our business. As long as you believe in your merit of your business, you will find a way to find money on this planet. There's no excuse.
Sure.
Right? So whenever I start a new fund, I know money is available. It's my choice to get it done or give up. And if you do a good enough job, enough good people come.
And besides your credibility, the primary reason that a limited partner would invest is because of the theme that you have. Each VC firm has their own philosophies, their own
way. Variety of reasons to invest. Of course, it's not just me, but me and my partners, senior colleagues. It's also about how you performed. So in the first fund, it's more about maybe you're a job where you made some angel investments. In the second fund, a bunch of other metrics that they expect to have done. You're mutually decided, got it. And then third fund, they get exits now because now they're 5, 7, 10 other curves going on. So each fund is very different.
Understood.
So, Sasha, tell us a little bit about your investment philosophy at a personal level. Like, there are many people who will say that, listen, I'll rather invest in myself because that will generate the maximum amount of return. Do you follow that? Or what is your investment thesis for yourself for that personal finance?
Yeah, good question. So, I lost a lot of money in the public markets.
Okay.
Because many people, unfortunately, listening to this probably will lost in the same way, which is tip-based investing or I just felt that this is the greatest stock in the world. So you end up working really hard, making minimal amount of money, free for myself. And that minimal amount, you then frivolously invest into something which, without any research or understanding of it. Because you feel that, investing is so easy, anyone can do it. Not really, there are great people doing public market investments or, whatever it doesn't just desire to do. So my strong learning after having traded for many years and now my whole, whatever little money I have private is doing really well. There's two ways to do it. One is I would just pick a SIP and put X amount of money into the SIP every single month till the day I die. And that compounding is so incredible, it will be a waste. So now what's happening is my time on that is zero. All I do is put SIP. And I don't even look at it some other day, my card says, Sasha, make up so much. Oh, that's the reason. Without thinking through. So what I've lost in 20 years, I made it 5-7 years.
Oh, wow.
And then I have some private money as well available through my family, which I help manage. There also, I said, look, we don't want to be experts here. So when I met 10 of the best investors in India, the public markets, understood what they do, what they look at. And once I met these 10, I knew exactly what they look for. I made a framework around it. I said, okay, now we will find investments only in this bucket, no matter what.
What are those step buckets if you don't?
The standard buckets that everyone knows.
Okay.
And then we know this ROE or whatever. But it could be companies that don't do M&A, for example.
Okay.
We don't want M&A companies.
Okay.
Because most M&A fails.
Yeah.
Yeah.
So don't worry. It sounds very simple, but suddenly 300 companies are out of my list.
Right.
I want to do this. Suddenly you only have 10 buckets to look at. And it's very simple. There are 6,000 companies, 5,000 already out. And then out of the 1,000, many of them are still not hitting those metrics. So suddenly there's only a couple of hundred companies in the universe that I need to track. And I go extreme long term.
Okay.
Not 1-2 years or
No,
I don't even know the price of these stocks right if you ask me. And how much is it worth that portfolio. I'm talking forever. So unless there's some massive change, for example, the founder suddenly changes his personality, starts spending money, buying private jets, or suddenly starts doing M&A, or suddenly over a 2-3 year period, not a 6-month period, the decay has happened according to the metrics, then I will sell.
Okay.
Of course, ethics, nothing to discuss. Goodbye. If they sell the company to somebody else, new management, obviously sell the very next day. Apart from that, I want to hold for 20-30 years.
And you keep sort of looking at this portfolio with these parameters every quarter or so, like you just do midday.
I have a young colleague who runs my family office called Olmo Capital. Maybe once a quarter we try, even a father, brother, and me. Because that's separate. We have our own separate businesses, right? A father, brother run their own electronics business, I run KAE. And we don't want to waste our time on that. Our team is best for what they do. That's why we've hired them.
So I think this question has been asked to you, but we just mentioned the electronic company. It's all Onida, right? Very famous brand in the country. So, I mean, you had the option of joining them. Why not?
I think life's about choices that you need to make for yourself.
Correct.
You're born into something, that doesn't mean you have to do it.
That's okay.
And my father has been always very, very encouraging person, so and my mother. And he always says, actually, you must do what you really want to do. If you want to join, you're welcome, but you will start from the base. I'm not going to make you a director. So I still remember joining. I did 6 years in Onida.
Okay.
So the first time I joined, first week, I thought, hey, in 6 months I should be a director of the company, my dad, Kevin. But I'm still not a director plus years later. And I think that's great parenting, where I said, look, if you want to be here, you need to go up the brand, which I did. With ran small branches, they were in Bangalore for 2 years. But then I realized that I liked another world outside of my family business.
Yeah.
And they already had competent people like my father, uncle, and now my brother.
Yeah.
So why should I have the fourth wheel in the same age? My cousins have really tried me well.
Yeah.
One has started a firm called Malabar Capital.
We podcast with Akshay 2 weeks
Yeah.
ago.
And his sister working in Everstone.
Yeah.
And they all be fine.
Yeah, because when we were sort of doing research on you guys, during your videos where you really attribute a lot of positivity to your father, that because of his ability to sort of so encouraging and positive with what you should do in your life, you were able to sort of make these decisions. I wanted to ask a little bit about the market right now, India as a market, right? So the last 5-6 years, and especially post-COVID, has been this massive bull run. And I don't mean, of course, stock markets. I'm just talking in general. I think since last year, it's completely, deflated. What's the situation right now? What do you see over the next year or two happening to India?
Wait, I don't look at India for 6 months over here. So I can't answer that question. Even the best economist probably can't answer it. The Fed is funny.
Yeah.
So I believe that I look at blocks. So I think 20-30 year blocks. Right. So I'm looking at India in the next 20 or 30 years being one of the most interesting countries globally. And there are a variety of reasons. I don't need to bore your audience and bore you with, the answers as to why in the next 30 years India's time.
Yeah.
Right. I believe that even 6-7% growth that we're growing is too low. We need to be at 10, and we can be at 10 if you make some structural changes. I can you imagine our economy at 10% a year compounding over 20 years, even at 7 or 8, it's phenomenal.
Yeah.
So it's a great time to be Indian and young and energetic to go build businesses. And hopefully people like you who are listening come to us for money. And if you don't, that's fine too, as I mentioned. We're going to see some unbelievable companies come out of our country.
Now, I have one question because he spoke about macro factors. Now, this is something which is, this is personally for me, I want to understand. When India prints money, okay, so assuming India prints 100 bucks, and there's 100 rupees in the economy overall, India can continue to print money as per earlier it was the gold standard. Now, what is it about?
Printing money is fine.
Yeah.
Right? And we continue doing that. But I believe that for us, it really doesn't matter.
No, it's not as a business. I'm talking about a macroeconomic factor that how does, and we keep saying that India's economy is growing. So does the money in the economy, right? One could be the exports, and one could also be the fact that India is also printing money. Mm-hmm. Now, when you talk about money overall, first it used to be backed by gold. Is it backed by anything now?
What I know, it's gold.
It's still gold.
Yeah, but I'm not an expert here, so you can double check.
One of the other things which I want to touch upon is your education. you still end up studying or going to Harvard degree. And I'm assuming next month you will be studying over there. And what is it like being in one of the classrooms over there?
I think it's phenomenal. Every time we start studying many months in advance.
Okay.
And then we form groups, we form a group calls with them so that we release campus. We're fully prepared with that subgroup. And then we are full on in January on campus. As human beings, we're always declining and losing something. Say 4-5% per year is being lost. We have to replenish that.
Correct.
So that's what I do by reading lots of books and then going to Harvard. Also, you feel young again, you go on a campus, you stay at Tata Hall. You meet some of the smartest people in the world, and more important, the professors are phenomenal.
Okay.
So it's the lowest with the open mind, saying, look, I don't have any agenda here, I'm just going to go with the open mind and just absorb. I said, absorb.
Yeah.
You can't not absorb something.
Yeah.
And I believe that we absorb so much. I mean, it's my 7th year this year.
Okay.
So we do.
And teaching style differences between what happens in India, you've been in India in a classroom, versus a B school like Harvard, which is considered the holy grail of education in the world. How is it that, if you can tell us the fundamental difference?
I know I took a bet because I think each country, and especially the top tier schools in India and top tier schools in the US, are obviously imparting phenomenal education. A lot of them are relatively similar to the case-based, at least the MBA programs. So I feel it's the same. It's just that some people want to go to the US and get the experience of meeting the advantage of the US is you meet people from different market countries. Global.
Yeah.
Perspective. Versus India is obviously more Indian perspective.
Correct. So more culture, more people, more ideas.
It's the same.
But somebody, see, you're very senior and successful.
I'm not seeing a force anyway. Like,
so compared to the 18-year-olds watching, right? So most of these guys are, or actually everybody I know for that matter, we think about education and academics only for the final degree so that we get the next step. You, I'm assuming, are either looking at knowledge or networking. First of all, is it both? Or
that's both.
Okay, it's both. And Howard gives you both in
like, at my age, if you didn't give me an A, I'd drop out immediately.
Yeah, absolutely. And but is there one is slightly better? Like, is it that after the last 7 years you must have met people which of course have translated or rather transcended into your professional life as well, and you have really done well together because you met them in Harvard? Or is it that listening, because you have so much of exposure irrespective in your work? So whatever the professors and whatever the others must have experienced, great to learn and add to your knowledge base. But is that as valuable as the network?
Both are valuable.
Both.
It's the way you take it. Some people go only for the network. And it's look, we are running large successful companies, I don't need this. But I, of course, participate. Some people going, see, I don't care about the goddamn network, I want to replenish my 5%. So I'm going to focus here and I'll be polite to people, but I want to go to my room and go to sleep.
Right.
So it depends on the individual. I like to take both.
And how much, if you can just share, right? What is the fees for this?
Yeah, that's the cost. He said it's the same. That's why I said we're not both for a price.
The fees, I can now afford because of my age, but when I was 18,
Our age, yeah.
very expensive. Why bother? I'm sure anyone.
I'm sure that every kid who wants to be you.
Find a way to go there. I found a way to afford the fees. Anything you want in life, you will achieve. Right? It's up to you.
Yeah, no. So the reason we are just asking is because we don't talk about, we know on an average what these fees are. We just want to hear from somebody who's been there, who's found so much value out of it, because somebody like you can actually cement and say that whatever the investment did over the last 7 years, you would have ideally made the higher return.
I can guarantee you that whatever fees I paid, it has already been paid back. And maybe those scholarship will have.
Okay.
I should ask TV.
I would have paid that thing to go.
So one of the things which I want to hear from you is people in India do degrees because it is required to get a foot in the door, not because they're investing in themselves. Education is one thing which people are finding it more and more difficult in paying a higher buck. Versus globally, what we are seeing is there's more acceptance on paying that fee. Alright, this is what we are sitting here with our minimal research. In terms of investing in education for yourself, would you say it's one of the best things to do at a very young age as well? Not just gathering deals, but investing in education. And one kind of education.
I think education, if it gets done for the right reasons, obviously very useful. And there's no harm in doing it whatsoever. And, at the end of the day, don't do something for society, but do it for yourself. So if you believe that this can help you in whatever reason whatever journey you have in mind for yourself, then do it. If not, don't do it. And many folks who are uneducated, you look at Bill Gates or Zuckerberg, midway through Harvard degrees, they dropped out, right? 99% of the parents will never drop out of Harvard. But they've done better than 99% of the parents.
Yeah.
But do remember, there were special people too. Pops out, Oh, Harvard can build up $100 billion company. They have $1 trillion company. Even
I think people become too invested in using the anomalies as the rule to making a justify any decision.
Life is not anomalies, right?
Life is not anomalies,
So you got to be realistic.
Yeah.
Without being curtailing your visions or dreams. Never curtail your visions or dreams, but be realistic as well.
Right, because recently, I don't know if you remember, last year there was this whole meme going, not meme actually, it was on social media basically, there was this whole code of Elon Musk going on, when he mentioned that everything in education is now available for free. But that's Elon Musk saying it because I've realized that most of us require a structured approach with direction, with somebody sort of on your head for you to actually end up completing it.
Life is about knowing yourself.
Yeah.
Don't listen to people like me or to anyone else. Know yourself. Ask the right questions. Have good mentors. It's not that complicated after that.
Who are your mentors? Because you spoke about.
I have many mentors. Of course, my father's been a great mentor to me over the years. I had many other mentors over the years. Mr. Rafiq Malik, chairman of Metro, Rans, which this did last year. But his company, by a human being, great human being, and obviously extremely wise human being. So he'd been my mentor for many, many years. Also, Pulak Prasad and Nalanda Capital, who's also a personal friend. If he hears this interview, when they're curious to mention his name, but he's been a mentor as well.
Great. So just as a concluding question, right? I know you are an voracious reader. We also try to do at least 25-30 books a year. We try to do one book every 1 to 2 weeks. I know you are slightly ahead of that as well. Can you tell us, and just bear in mind, this is for actually our audience as well, right? Young, enthusiastic people, either wanting to enter the world of finance or entrepreneurship. And let's say they've never read a book, they've not really taken the time except for their textbooks to really read for, like you said, for investing in themselves. The top 3 books that you feel it's a combination of learning, of good book as the first book, for example, Principles of Great Value, we really enjoy. But so somebody like you can just suggest 3 top books.
It's like picking $1 out of $2. So I'm not going to pick, maybe just randomly come up with names. Open by Henry Agassi, sort of a finance book. So I strongly recommend people read that.
And he hated plain text. Yeah.
It's a great book. So I recommend this for life. And let's say Phil Knight's book, The
Shootout.
They're both huge fans, by the way.
That's right. So those are 2. I can go and give you 200 more names. I'll go to my cabin, you can take out names. But let's start with these 2.
Okay. And any any book on finance which people can read and just get excited about learning?
I didn't read any finance books when I grew up. I like to read biographies of people. Many people don't, but I love it. Talk about their lives and how they've done it.
Yeah.
There's so many. So in fact, I encourage a lot of Indian senior founders of companies to look.
The global context, because everything we read is US or Europe or maybe now China centric, but we don't know. I mean, there was a book on Dhirubhai Ambani, which obviously is not there anymore, Polyester Prince. But we don't have access to a lot of Indian entrepreneurs.
We have seen that trend change.
Yeah.
Maybe Mr. Harsh Maiwala,
Yeah, super.
I just read the Butcher's book, Mr. Narottam Sukhia. I read one more book, I don't remember this year, of an Indian farmer. So there's plenty of books coming out now. We need the Indian farmers.
Exactly.
We want to, but just one last thing. I know Pratham said the concluding question, but just, I know you would not like to compare things so far. So this interview, you've been very, very conscious of that. But there's one factor which I want to ask of you in black or white. You think it's tougher starting a business and succeeding in India than it is probably in the United States because there's so much available information in the United States which is there?
That used to be the case. It probably still is the case, but India has improved dramatically with the time that people like my father started. They have access to capital even 2000.
Is that also the reason why a lot of people or parents are dissuading their parents to their kids, saying that probably delayed the decision of becoming an entrepreneur? Things like
that dissuasion still continues.
Yeah.
But has it improved? Because you need role models. So there's enough of more role models. Because Nayamurthy became an amazing role model.
Yeah.
So many people started quitting. But now there's so many more startups that have done well. So it's easier for the young founders getting out of the IITs. Why IIT? Any college or any job. Say, hey, look, these are the examples, these are the role models. So it's a network effect. You see more role models, more people feel confident, the parents feel confident. And I hope that more parents encourage kids because we need more entrepreneurs. Entrepreneurs drive the world. And therefore, without them, none of us can function. You guys are great examples of that, right? Started your own company.
Thank you so much, Sasha, for the kind words. And pleasure to have you on this. We'll definitely see you down the road. And if this picks up, we'd love to shoot a part 2 with you. So thank you so much.
Pleasure. Thank you for inviting me, guys.
Thank you.